Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel, and this episode is again brought to you by CWOs for Hire, which is the financial planning firm that I co-own with my partner, Dennis Fry, where we focus on retirement and tax planning. Today, we're going to stick on the topic of investing, whereas in previous episodes, we talked a little bit more company specific in terms of knowing who the management is, listening to earnings conference calls, understanding the balance sheet, the cash flow, what the company does, all those things that are more company specific. Now let's back up a little bit and talk about a broader topic of supply and demand. We'll hear the idea of supply and demand in economics and pricing quite often, but sometimes it doesn't get talked enough about in terms of stocks and other investments, because supply and demand absolutely does matter, especially from a more broad market level, less so on the individual stocks, although sometimes that could be the case. But on a broad market level, supply and demand definitely has an impact on the prices of different investments. We'll see this show up usually in three different ways when we're talking about investing in stocks. The first would be if there's other alternatives. So for example, when we saw changes in interest rates, that had a big impact on stock valuations. When interest rates were near zero, there wasn't a ton of alternatives to investing in stocks. Obviously, you would still invest in some bonds, get some interest. Money in the bank didn't really pay you anything. So there was a little bit more of a nudge towards investing in things like stocks. Because if you wanted to get a really a better return or a higher possibility of return, you're going to have to be in stocks because other items like bonds, CDs, they just weren't paying out as much. Now, when interest rates rise and all of a sudden you can get 5% on a U.S. Treasury or 4 to 5% on a CD somewhere, now you have some alternatives that stocks have to be balanced against, because stocks have risk. Over the long term, they've tended to go up and been a fantastic investment. But that doesn't mean they're risk-free, whereas something like a treasury, very much risk-free unless the entire government collapses, and that's a whole different scenario to be planning for. So now that you have higher interest rates, there is some alternative to stocks, and that can weigh on stock prices, at least in the short term. Now, we've seen the stocks come out of that just fine. We saw that 2022 was a rough year, both for bonds and stocks, because interest rates had gone up. But after that, it's been pretty positive in terms of the returns. So it's not that you have to have one or the other. It's just a matter of understanding that previously, when interest rates were really low, there wasn't a great alternative to stocks in terms of long-term growth. Now there's at least some alternative to weigh against when you're getting paid interest rates of 4 to 5+% just to have money sitting in a treasury or a bank account or a CD. So that supply and demand dynamic will always be there and will always impact prices of stocks that you are looking to invest in. The other area that we see quite often with supply and demand is companies coming public. So if you are looking at the entire universe of public companies, the more you add to them, the more you increase the supply, and there's only so much money to go around for all that supply of stocks. Recently, we haven't had very many companies coming public at all. There's been a handful, but it's been pretty light activity for probably the last year and a half at least. I'd have to look back at the timeline, but it's been pretty light for a long time. So you haven't had a ton of supply coming into the market, but you're still going to get new money coming in, even if just in the form of new 401k contributions from people working and just having it deducted from their paychecks, and then the employer matches that. And you're also going to get some flow in and out from bonds and money markets. So there's always different places for money supply to come into the market. But the point here is that if you're not getting a new supply of companies to invest in, you might have the same amount or more money there, but you haven't increased the supply of companies. Therefore, the existing supply of companies is going to naturally be worth more because that supply of companies is lessened. Conversely, if you get a whole bunch of companies coming public, that eventually will catch up to the market. And we've seen this happen quite a bit where the market's been great. So a lot of companies are just coming public. And that's wonderful. It creates a lot of excitement. It might even bring some money off the sidelines and into the stock market overall. But in time, when you start building and building and building this supply of stocks, if the supply of money can't keep up, well, then really by definition, the prices of stocks starts to at least steady or stagnate, if not come down, because all of a sudden you have all these new stocks that have come public. They're looking for money. Money goes to them. That money has to come from somewhere. So if it's not coming from cash on the sidelines or from bonds or money markets or wherever, then it has to come from other existing stocks. So you can start to see some pressure on stocks overall. Again, not a disaster, just something to be mindful of when we're talking about supply and demand dynamics. If a lot of companies have been coming public and sucking up a lot of money supply, we just have to be cognizant of, well, there might not be enough new money coming in to really take care of all the supply that's out there. The last point goes a little bit more to a micro level when we're talking about individual stocks and supply and demand. And that is the impact of companies buying back their own stock. Now, in this case, it can actually be really helpful to the stock price. Not all buybacks are created equal. Some companies are amazing at it. Some companies are terrible at it. And there's been a long history of companies where the company's just doing really poorly and the stock price declines. And the company says, oh, wow, look, our stock's really cheap. We're going to announce a big buyback. Well, if the company itself isn't doing well, a buyback's not going to help. All you're doing is lighting the money on fire while the stock price declines. So we've seen that plenty of times where a company has, I'd say, a little bit too much confidence in itself, especially when it's not doing well. And it decides, oh, we're going to take our spare cash and buy back our stock when it's cheap, not really understanding that it's about to get cheaper because the company's not doing well. So fix the company first, people. Then we can talk about buying back the stock. So you see plenty of examples of poorly executed stock buybacks. But there's also a lot of examples where a company is able to really provide a floor under their stock because they're running the company well, the earnings are steady, the cash flow is steady, and they can take advantage of declines in their stock price to remove the stock supply and have fewer shares of their stock outstanding. What that does is it provides a larger number of earnings per share. So if the company's earnings, even if they're steady, but especially if they're growing a little bit, you now have a smaller denominator in terms of number of shares, and the higher numerator, or at least the same numerator, creates a greater earnings per share. So when done well, and I think Apple's probably one of the premier examples of this, but there's plenty of other companies doing this, where when this is executed well, they can take advantage of all the drops. They can keep their consistency of cash flow rolling in. They're buying back the stock. They're taking supply out of the market and creating, they're not necessarily creating a greater demand, but they're creating a more favorable supply and demand balance by taking the supply of their stock away from the market when the prices get cheaper. So all these things to consider, not saying any of them are good or bad, right or wrong, but when you're investing, it's important to understand that there is a supply and demand dynamic just like anything else. And it's not always going to be linear. It's not always going to be perfect. We can't necessarily track exactly where all the money's coming from at different points in time. But it's just important to understand conceptually and directionally what might happen as money is moving in and out, as interest rates change, as new companies come public or not, as companies buy back stock. All these things just are there to take into consideration when thinking about where stocks might go in this supply and demand dynamic.